This is probably one of the best risk-adjusted environments that we've seen in the past 18 years. So when we started in 2005, private credit was about 5% of the leveraged finance market. We've seen a significant secular shift towards private credit, away from the public markets, driven by two things: investor demand and companies that are seeking more flexible capital solutions. Part of the reason we saw a shift towards private credit in 2022 was because we saw the public markets experience a lot of volatility. As companies were looking to finance growth, they had to access the private markets because of the backdrop. I think one of the biggest misconceptions about private credit is that it is a higher risk asset. And I would argue the opposite is true. When we make a private loan, we own that risk for the duration of the term. Very different than the public markets where you can trade risk, we own that risk. And so you need to set up your investment approach to be highly defensive. You need to be senior, you need to be in the right sectors, you need to be in scaled businesses, and you need to have the right structures. The combination of which creates a more protective and defensive investment approach. Blackstone Credit is focused on businesses that have very good long-term growth trends, but also that generate a lot of cash so that they can service their debt. When we lend money to a company, we're not just giving them capital, but we are acting as their capital partner, which is most important in periods of complexity. When something happens to the business that's not planned, at the end of the day, our goal is to build wealth for our investors and to build value for the companies that we lend to, which we've done well over a long period of time.